Joining us this morning is Citi analyst Tyler Radke, maintaining a buy today, lowering his target from 375 down to 370. It's good to have you, Tyler. Welcome.
Thanks for having me.
What'd you make of it? Is it about the sort of ratio of the CapEx move versus the forward booking revenue move or something else?
Yeah, I think there's a lot of things, but look, I would say put simply, the debt market is in control of the narrative right now, right? So you saw them, obviously, I think, come in with a very strong bookings quarter, their second strongest bookings quarter they've ever delivered, but you didn't see near-term numbers move up. Now, they did raise next year's revenue by $4 billion. At Analyst Day 2 months ago, they put out some pretty ambitious 2030 targets, over $20 of earnings. So we're focused on where is this company going. There's definitely a little bit of uncertainty, some near-term revision issues in the model, but this is something we're hearing from Microsoft, right? They're continuing to see the capacity constraints that's weighing on near-term growth, but overall growth is accelerating, bookings are accelerating, cloud revenue is growing faster than it was last quarter. We think that continues. Clearly, there is a little bit of uncertainty, though, on the financing side of the equation. I think that's what the market wants to hear.
Right. Is OpenAI sort of a weight around its ankles? And by the way, we're going to talk more about it with Disney. Does that change any of that?
Yeah, I mean, I think that is issue number 1 or 2 from investors. It's the financing thing, and hey, what's going on with OpenAI? Can they pay you $300 billion in their contractual commitments longer term? So obviously, we'll get an update in a little bit here, but our view is, look, AI, this is a massive market opportunity. If it's not OpenAI, it's going to be somebody else. These data centers are fungible. If it's not being sold to OpenAI, they could go around and quickly reconfigure that to somebody else. We think they can make very good money selling this over $20 of earnings by 2030. So I think in a year from now, this provides a good entry point.
How extreme can the CapEx, the revenue to CapEx, the CapEx to revenue ratio get? Where are we right now? 3/4 or so of your revenue?
Yeah. And look, I think the reality is the CapEx is a read on that forward revenue, right? So we're expecting revenue to grow 3-4x from where it is now. But of course, you have to front load those investments, right? Data centers are very capital intensive. I think a good analogy, though, is if you look at the early days of public cloud, what were Amazon with their AWS business doing? They were not free cash flow positive for so many years, right? So this stuff, you have to put in the money early, but it's very fruitful as customers ramp up. You start to sell on more profitable services. That's what we think is going on at Oracle.
But in some ways, it's asking a lot of Oracle investors, at least long-term ones, who are very much accustomed to a company that generated a lot of cash flow.
Absolutely. I mean, their free cash flow is negative. They're increasing their leverage. This is a more capital-intensive business, but you're seeing it across big tech, right? Meta's free cash flows come down significantly. Microsoft, they're not, dipping into the red, but $80, $100 billion of capex is a huge number that Microsoft wasn't doing in the past. Oracle, it's more outsized because they are playing catch-up, right? They missed the early days of public cloud, but we do think that they have something differentiated here, and so I think this investment makes sense provided you have that confidence.
So when does the stock start to reflect your optimism?
I think you need to get an update on the financing, right? Which you should get in the next 1 to 2 quarters. So I think over the 6 to 12 month time frame, obviously if OpenAI monthly active user growth starts to reaccelerate, that helps too. That's difficult to predict, but certainly looking forward to hearing what Sam has to say.
But they're likely to maintain investment grade, aren't they?
Yeah, so
isn't that an important point? And they have alternative. I think they talked about this. Exactly. They have alternative financing solutions.
Right, and so they can tolerate another downgrade to BBB negative, I believe, before they kind of get out of that investment grade. They talked to us last night. They said we're very focused on maintaining that investment grade rating. But again, there's other options. Customers could bring their own chips. There's vendor financing. We've seen a lot of these creative financing moves in the industry for sure.
Do you see them coming back to the debt market with some regularity in early 26?
Yeah, I think we're estimating that they need to raise about $60 billion of debt over the next 3 to 4 years.
Next 3 to 4 years.
Yes, and so obviously they took up their capex numbers, and so between that they have some debt coming up for maturity. They will need to do some raising. Now, could that be a convertible offerings, a mix of equity? That's hard to say, but we do expect them to raise some money here.
And you think it would be well absorbed? You think?
I think that will provide clarity, right? What markets obviously don't like is uncertainty. So I think the extent you get clarity, and again, you get clarity on the numbers moving in the right direction.
But not just debt, it could be equity too, you're saying, right?
It's possible. Look, I mean, I think they were pretty clear to us. They're not going to do a share issuance, but if you look at some of the signals in the debt market, right, the spreads are growing, right? So if you do some interesting, creative debt-backed convertible type stuff, right?
But the backlog number, I mean, that was the key number, right?
Absolutely. Grew 440%.
$523 billion deal backlog. What does that translate into revenue growth, and when's it going to be enough for the street not to worry about all this?
Right. So I think what's interesting, of that backlog number, massive growth, no question. A lot of that is long dated, right? But if you look at the current piece, which is the revenue expected to be recognized over the next 12 months, that accelerated meaningfully. So that grew over 40% this quarter. So I think you are starting to see that backlog flow into revenue. Again, their business is accelerating faster than basically anyone out there. Obviously, the bar is high, expectations are high, but this is, it's a stock trading with a 30 times, if not a little bit less, on earnings. So it's not a crazy valuation for something with a huge growth potential.
Right. That is putting the pedal to the metal like they are.
Yeah.
Tyler, thanks. Good one. Appreciate it. Tyler Radke over at Citi.